Welcome to Realcast, the weekly roundup of the real asset markets. I'm joined by Dan Innes and Paul Strome. Dan, let's start with you. What have you been tracking over the week?
Well, last week I went to the local data company's 26th retail and leisure report, which focuses on the UK. It's pretty much shined a light this year on recovery. The headline figures showed a positive trajectory. Retail and leisure, like most sectors, that's bounced back quite well, but mainly thanks to declines in vacancy rates across all regions. So still a decline, but not as bad as it was. So bodes well for the second half of this year. But, the retail sector has shown a lot of resilience, following a reduction in business stimulus packages in April, which didn't cause significant disruption to the market. But recent vacancy data has shown a bit of a slowdown in recovery, and that's expected to continue into 2023. The number of closures across Britain down 7% year on year, dropping from 26,703 in the first half of 2021 to 24,832 in the first half of 2022. That even falls below the pre-pandemic closure figure of 25,762, and it's the lowest closure figure since the first half of 2018. So, there's something to look forward to there. Vacancy rates are continuing to decline, but that's been mainly driven by the leisure sector. The leisure vacancy rate continues to see, the greatest year-on-year improvement. City centres are continuing to lag behind other town segments. Although it's been over 2 years since the start of the pandemic, we're still yet to see, a new normal for city centres. The tide is beginning to turn for shopping centres. They saw the most significant recovery of any location type in this first half period, with a net change in units falling from minus 3.3% to just minus 0.3% in the first half of 2022. So shopping centres, they've faced difficulties over the last 2 years due to closures from several big brand names. But as more investment and development plans come through for the shopping centre sector, we can expect vacancy rates to decline following their all-time high during the first half of 2020. And in other news, last week, in one of the city's key office transactions of 2022 so far, Landsec has sold the Deutsche Bank HQ building to Lend-Lease for £809 million. According to many analysts, that's quite a significant cost cut and a bit of a disposal that lays bare the impact that rising rates have had on commercial property pricing. But, it shows that an expected recession possibly is on the way, and that really, according to agents, the 21 Moorfields site was valued at around £900 million as recently as March this year. But since then, rising rates and inflation have added up, to costs facing investors and developers, and have seen that end of the market kind of slow down. So, but nonetheless, a significant transaction for the office sector in the city.
Yeah, it's interesting, of course, to see that focus on leisure. I noticed as well that the GIC, Singapore Sovereign Wealth Fund, entered into a strategic partnership with Mediterranean Luxury Resort Group, Sani Ikos, for 2.3 billion. And of course, MAPIC is going to have a very big focus on leisure, and that's certainly driving some of those markets. Paul, what have you been watching?
Well, research firm Bonar have released what is really an opinion survey on the residential sector, looking at factors behind the sector's success. It's been talking fairly broadly about rented residential categories, including student space. Among the conclusions, Bonar states that the sector is poised to remain a more lucrative investment opportunity than asset classes such as office or retail, and that it's producing higher prime yields than other traditional real estate asset classes. Bonar also cites healthy demand, resilience against the economic crisis, rising rents and high occupancy as further reasons to invest. The firm points to rent rises of 3 to 7% in Western Europe and up to 10 to 15% in Eastern European countries, but without adverse effects on the level of demand because of the shortage of alternatives. It also points to the rise in interest rates, which make mortgages more expensive and property harder to afford. Furthermore, the firm points out that currently 30% of Europeans rent their housing, and this proportion is expected to grow owing to increased urbanisation, higher mobility, later marriage, and increased level of single-person households. A couple of big deals add fuel to the fire this week. Tristan Capital Partners CCP5 fund and its joint venture partner Ikos Group have acquired a 999-bed PBSA asset in UK city Liverpool from Aura investors paying £110 million. The purchase expands the joint venture's PBSA platform to over 2,100 beds in Birmingham, Manchester, Glasgow and Liverpool. Liverpool's one of the UK's leading university centres, has more than 70,000 students and 5 higher education institutes. And Tristan said the growing demand from both domestic and international students in Liverpool made it a compelling addition, and said its short to medium term objective in the UK is a £750 million platform. Other announcements include CBRE Investment Management acquiring a 133-unit residential asset in the Pankow district of Berlin, about half of the units being private rented sector, the other half let to a charity that provides homes for senior citizens. Ben Heinz has acquired land to develop a high-quality mixed-use scheme in the Berlin-Schönberg district in a joint venture with 5 German pension funds. The project is close to the Südkreuz city quarter, which is a future-oriented city quarter established by Heinz and comprises 664 residential units, ancillary services. That city quarter idea seems to line up with the 15-minute city idea. And this week, C40, which is a global network dedicated to combating climate change, comprising 100 city mayors, formed a partnership with Nordic real estate investor NREP. Together, they have launched a program designed to provide proof of concept for 15-minute city policies. The initiative was launched during the New York Climate Week and is intended to empower cities worldwide to create ambitious net zero and people-centered neighborhoods. The new initiative is called the Green and Thriving Neighborhoods Program. Will implement pilot projects in at least 5 cities around the world. The Intergovernmental Panel on Climate Change, IPCC, has pointed out that compact and resource-efficient cities can help cut urban emissions by around 25%.
Yeah, it's interesting, that discussion around those leading cities and sustainability. I did an interview with Susan Aitken, Glasgow City Council leader, about the legacy from COP26 as we move towards COP27. And you can read that in the Expo Real special edition of Impact magazine. The focus as well over the week has obviously been interest rates, with rate rises again in the US and also in the UK. And a lot of focus on that, with economists expecting to see interest rates to go higher. And of course, that's a major topic for the real estate side. Thank you, Dan. Thank you, Paul. Thank you for joining us, and look forward to seeing you next week for our regular roundup of the real asset markets.